Welcome back, accounting scholars. We are now ready to move on to a new area of the chapter, which has to do with something called internal controls. As this picture shows, the uh, the analogy holds here, where this could be some employee and there's some barbed wire stopping him from doing something. That's essentially what internal controls are in a company. It's the processes and procedures that are put in place so that a company's assets are protected. If they don't have the appropriate proper procedures and processes and systems, the company runs the risk of being exposed to employee stealing or customer stealing. Internal controls are very important. So in this particular area, um, we're going to talk about the number one procedure is proper authorization, meaning that um, you know to do certain jobs in the company, they have to be properly authorized. Second is separating incompatible duties. Um, if you are responsible for quality control, you wouldn't necessarily want to be also responsible for uh, manufacturing products as well. Usually, they keep the manufacturing process and the quality control process separate, so that there can never be any conflict between the two. Uh, the third is maintaining adequate documentation. If you want to have appropriate internal controls, uh, you have to have good records, and that's what adequate documentation is. And then the fourth procedure is physically controlling assets and documents. And specifically, that means that there's the appropriate security procedures, so people aren't walking away with valuable items from the company, as well as valuable documents. Not the least of which is cash or securities that might be marketable, might be able to be used outside the company. And then the fifth is providing independent checks on performance. And sometimes companies will actually bring in outside organizations because they will be independent to check to see how the company is doing in various areas, as opposed to having another employee check on internal controls. Okay, one of the most important aspects of any company is their cash. As I mentioned, cash is the oxygen of a company. So if you don't have internal controls to protect your cash, you got some big problems. So what are the internal controls for cash? The first is cash receipts. Uh, you know, if you're taking in cash from the customer, have to know exactly how much cash is coming in to the penny. If you don't know how much cash is coming in to the penny, you got a problem. You have an absolute problem. So there's got to be excellent records in terms of cash receipts, in terms of the separation of duties and who controls cash, as well as the physical control of cash. Cash disbursements. When a company makes a payment, who has authorization to cut checks, to write checks, as well as who has authorization to approve those. Typically, there needs to be a separation of duties. Bank reconciliation. Bank reconciliation is very important. You're going to keep a balance of your cash in your internal accounting system, so you know what your cash balance is at any given point in time. But the bank will also be keeping a record of what your cash situation is, because you will have cash deposited in the bank. So at various points in time, just like your parents reconcile or balance their checkbook at the end of each month when they get a statement from the bank, a business does something very similar. They balance their books against the bank statement, usually at the end of each month. What is specifically a bank reconciliation? It is literally the process of comparing your internal accounting records of cash to the bank records. And there are specific areas where and processes that are used to actually do a bank reconciliation. And it's usually the process of a two-column reconciliation. By this I mean both the bank records and the accounting records are adjusted so the balance is the same. And this usually involves the adjustment of several items, specifically outstanding checks are usually added to the bank balance. By outstanding checks, meaning that you are checks that you wrote that the banks do not have. I'm sorry, you would subtract outstanding checks from the bank balance because you have written the check and the bank has not deducted it from your balance. So that would be a subtraction. A second would be deposits in transit. If you send a deposit through the mail, meaning a cash deposit through the mail, you would need to add that to a bank balance. And the third area would be the errors made by the bank. And that could result in adding or subtracting those errors from the bank balance. Now, what are the adjustments that would be made to your internal balance, book balance, your accounting records that you've been keeping of your cash? Well, in this particular case, if you have earned any interest from the bank on the money that you had deposited there, you would add the interest earned. In the terms of service charges, you would typically subtract the service charges. And these service charges could take a variety of forms. It could be in the area of non-sufficient funds, NSF checks. If you bounced an NSF check, is a bounce check, meaning that you wrote a check and you did not have the proper amount of money in the bank, and the check bounced back. That's not sufficient funds check. There typically would be a service charge for that, but you would also have to subtract the actual check amount. And then here again, you would either add or subtract errors that you made. So those are the areas that are related to the check reconciliation process. Okay, ladies and gentlemen, we are at 10 minutes and 20 seconds. Thanks again for being such a great audience. This is the last module for this particular chapter. Good night.